Yo, I'm Brendan. What's the difference between APR and APY? Today, you and I, once and for all, will memorize this enough that we can stop Googling it, and we'll also know what's a good kind of range to hopefully be in to get a good version of both of those. To start off with, APR is the yearly cost of borrowing money. Remember it this way. APR is the rate that you pay, like an interest rate, like for your credit card, for your mortgage, for your car loan, for your student loans. R is bad. The rate is bad. We want that to be as low as possible. Annual percentage rate. So what's an example of like an average APR right now for something like a car loan? These kinds of things change a lot over time, but for the second quarter of 2024, the average auto loan interest rate was 6.84%. And that was for new cars. For used cars, get this, yikes, this is so painful. The average used car had an APR of 12.01%. That is wildly high. That's very expensive. The cost of borrowing right now is very expensive. If you're watching this in 2030, maybe it's gotten a lot cheaper. I hope so, but for right now, this is very expensive. The average mortgage rate is also very high right now. So it depends on the kind of mortgage you get. I mean, a lot of these depend, but if you've got pretty good credit, then a 30-year fixed rate mortgage right now is almost 7.5%. Yikes. A 15-year mortgage is a lot cheaper at 6.5%, well, 6.46, whatever, but it's still pretty darn expensive. And a 10-6 ARM is up there at 8.15%. The goal with APR is to have it be as low as possible. And the way that we typically get there is by having a really good kind of credit score and a credit history in general. So you want to be someone who proves to a lender like a bank, you can pay this thing off, you won't have a hard time paying it off, and you're really on the hook for the loan. So you might get a better rate if you put more money down, or if you've got a longer credit history, maybe you've got a deeper credit history. You're not just like having one credit card. Maybe you've rented in the past and you've got a mortgage and you've got a car loan and you've paid all those off really, really well, and you have a high income, so you've got room left to accept more debt. That's going to be a really attractive person to a lender. If any of those things go wrong or they're not, perfect, then you're probably going to have even worse rates than this. So the way that we get ahead typically financially is minimizing our APR and maximizing our APY. Let's talk about that next. APY is the yearly amount of interest you earn on savings accounts, investing accounts, money markets, all that stuff. And Y is good. Y for yes. APY means yes, we want more of this. Give me a higher number. What it really stands for is annual percentage yield. But who talks about yield in terms of things like that? We're going to call it yes, the yes rate. As of right now, the kind of average high yield savings account is around 4%, maybe 4.5% if you're lucky, but those rates have been going down lately because the Federal Reserve has been kind of changing things on their end, and so the rates are kind of on a downward trajectory right now. They've been historically high, which has been nice. If you've had cash that you've put in those accounts, you've earned some good interest on it, it's been good. Our AP yes has been high, but if you wanted to earn even more money, you could have done things like investing the money. So what's a good APY to expect when you're investing? What's a good annual yield? Admittedly, this chart is almost 10 years old, but it gives you kind of a visual of a spectrum of things that you could expect. From 96 to 2015, REITs did really well, 10.9%. Wow. That's a real estate investment trust if you're not familiar with that. Think of it like a group of people put money together to go invest in real estate together. That's kind of what a REIT is. The S&P 500 is a chunk of the 500 biggest companies in the stock market. During that time period, they got a little over 8%, 60-40 in terms of like stocks and equities that you're invested in versus 40% bonds. Got a little bit worse. Then 40-60 is a little bit less equities, a little bit more bonds. That did even worse. Bonds are about 5%, gold 5%. Inflation back then was really low, only 2%. And the average investor got 2.1%. If you've ever seen my videos and you've heard me bash day trading and stock picking and following the news trends and doing what your Uncle Larry recommends, you know this is why. The average investor does really bad because we trade too often. We pick some name brand things we've heard of in the news or whatever. We get in and out too often, and we'd probably do a lot better if we just did something like the S&P 500 and did nothing. But how about a little bit more up-to-date data? This is from Yahoo Finance. This is the S&P 500's return versus the average retail investor. And this is just a little like 2-year period. So November of 2021 to April of 2023. I realize it's like a weird, awkward snippet in time, but this is a nice visual I found online, and I think it's still telling us a similar story. The average retail investor, the average individual person, who's not working for an investment firm or whatever, that's what a retail investor is, has done hugely worse than just the S&P 500. Our big hunch that Tesla's going to keep growing like mad, or that Palantir is going to turn around, or Nvidia is going to never stop growing and all that jazz, it leads us down this blue line to the point where we've got 27% worse returns than the S&P 500. This is madness. Here's another version of a very similar story from August of 2023. And what it's showing us is the gap between the average person and the index, like the average person's bad decision making, has lost them this much money in this gap area compared to if they had just followed the actual thing they were kind of tracking in the first place. So the average investor return as an average of all these things was 6%, and it should have been 7.7% if we didn't try and time the market and get in and out. If we didn't try and be really intelligent stock pickers and do this and that, we would have actually made 1.7% more here. Enough soapboxing about how we're bad investors and we make bad decisions and we could have done better if we just followed a stock market index. The summary is APR is really bad. The rate we're paying for things, we want that to be low. We want it to cost us as little money as possible to buy a new thing. APY is our yes. We want that to be as high as possible. High savings account rates, high CDs, high money markets, high returns in the stock market so that we're making as much money in this direction and we're losing as little money as possible in this direction. If you have any ideas that can help us to abbreviate that or remember it better, APR versus APY, then leave me a comment and that'll be the secret common word for today. Otherwise, thank you guys so much for watching and I'll see you next time. Bye.